Something is wrong. You can feel it, but you can't name it. The numbers look fine on paper. The headlines say everything is stable, but something in your gut keeps pulling at you. The same feeling hit millions of people in 1929, and in 2008, they ignored it too. What if this time, history isn't just rhyming? What if it's screaming, welcome to untold wealth theory? And if that question just unsettled you a little, good. It should. Let's go back. Not to 2008, not even to 1929. Let's go back further, to a moment most people have never heard of, because it didn't happen in America. It happened in a small Dutch city in the 1630s, and it set a blueprint that has repeated itself almost exactly ever since. It was called Tulip Mania. And before you roll your eyes, well, this isn't just a history lesson about flowers. This is about the psychology of collapse, the mechanics of how ordinary intelligent people convince themselves that this time is different, that the rules of economics somehow don't apply to them, that wealth can keep growing forever on nothing but confidence and momentum. In 1636, a single tulip bulb sold for more than a skilled craftsman made in an entire year. People mortgaged their homes. They liquidated savings. They borrowed money they didn't have to buy bulbs they couldn't use because they were certain someone else would pay even more tomorrow. It wasn't greed making them stupid, it was something more dangerous, a collective belief that value had been permanently redefined. And then one morning in February 1637, buyers stopped showing up. Not because anything had changed overnight, not because there was a war or a plague or a policy shift. They stopped because enough people all at once quietly asked the same question. Wait, what is this actually worth? That question asked by enough people simultaneously is what ends every bubble in history. The market didn't slowly deflate. It didn't gently correct. It collapsed within days. People who were wealthy on a Tuesday were financially destroyed by the weekend. And the most haunting part, most of them never saw it coming. Not because the signs weren't there, but because they were too invested to look. Sound familiar? Here's what most financial content won't tell you. The collapse itself is never the real story. The real story is the decade that builds toward it. The slow normalisation of things that should have been warning signs. The gradual shifting of goalposts until nothing looks alarming anymore, even when everything is. If you've been paying attention to the last few years of global economics, and I suspect you have because you're here, you've probably noticed some things that feel slightly off. Asset prices that don't match underlying value. Debt levels that keep getting described as manageable without anyone explaining by what measure. Interest rate decisions that seem less like policy and more like improvisation. And a general sense that the people who are supposed to have answers are mostly just buying time. That's not cynicism, that's pattern recognition. And the pattern it matches has a very specific name in economic history, the late stage credit cycle. Every major financial collapse since the Industrial Revolution has followed a version of this arc. Credit expands, asset prices rise. People who took risks early look like geniuses. More people take risks. Standards loosen. The rise starts feeding on itself. Then at some point, and nobody ever agrees on exactly when, the expansion stops being driven by real growth and starts being driven purely by the expectation of more expansion. That's the moment the structure becomes hollow. Not broken yet, just hollow. And a hollow structure can stand for a surprisingly long time, right up until it can't. Now here's where 2026 enters the picture, and this is the part I want you to pay close attention to. We are currently sitting in one of the most unusual post-crisis economic environments in recorded history. After the 2008 collapse, central banks around the world made a collective decision to flood the system with cheap money. The logic was reasonable. Stimulate borrowing, stimulate spending, prevent a depression. And it worked in the short term. But cheap money, sustained over a long enough period, changes behaviour in ways that are very hard to reverse. When borrowing is cheap, businesses don't optimise. They expand. When returns on safe assets are near zero, investors don't conserve. They speculate. When housing prices keep rising because of artificially low rates, people don't wait. They buy at prices that make no historical sense, because waiting feels more dangerous than overpaying. For over a decade, every time this system showed signs of strain, the response was the same. More stimulus, lower rates, more liquidity. Every time. until inflation forced a rethink, and the rethink, when it came fast. Rates rose faster than at almost any point in modern history. And here's the thing about a system that has spent 15 years adapting to cheap money: it doesn't adapt back gracefully. This is where history becomes your most important asset, not your portfolio, not your real estate. History. Because in 1929, the crash didn't come from nowhere. It came after the Federal Reserve raised rates aggressively in the late 1920s, trying to cool a speculative stock market. It came after a decade of expansion that had convinced most of the country that the old rules of economic caution were obsolete. It came when the debt that had been quietly accumulating suddenly met a world where rolling that debt over became too expensive. Does that sequence sound familiar to you? It should. And in 2008, the collapse didn't come from a single bad mortgage. It came from a system that had repackaged risk so many times that nobody truly understood where it lived anymore. It came from the assumption that housing prices were a one-way street, that whatever the asset was worth today, it would be worth more tomorrow. It came when reality sent a bill for years of deferred consequences. The pattern isn't that crashes happen randomly. The pattern is that crashes happen when a system has spent years avoiding short-term pain by borrowing against the future. And the future finally arrives. If you found this kind of thinking valuable, consider subscribing to Untold Wealth Theory. This channel exists for exactly this: the economic history and structural thinking that most financial content skips past, because it's harder to package than stock tips. So what's different about right now? What specifically makes historians and structural economists look at 2025 and 2026 with something more than standard caution? Several things are converging at once. Global debt, government, corporate and household, is at levels that have no peacetime precedent. The commercial real estate sector in the United States is sitting on losses that haven't been fully realised yet, largely because accounting rules allow them to be deferred. Regional banks, many of which are heavily exposed to that sector, are quietly under stress in ways that don't make front page news until they suddenly do. Meanwhile, the consumer credit market, credit cards, auto loans, buy now, pay later products, is showing delinquency rates that have been rising steadily for the last 2 years. Not crashing, rising, gradually. The way water rises before a flood, not the way a wave hits. And none of this exists in isolation. These are load-bearing walls of the same structure. When one begins to buckle, the stress doesn't disappear, it transfers. That's how systemic risk works. That's how 2008 worked. Not one bank failing, one failure revealing how connected everything already was. Here's the psychological piece that I think matters most. And this is what history keeps trying to teach us if we're willing to hear it. Collapses aren't shocking because nobody saw them coming. They're shocking because the right people saw them coming and weren't believed. Irving Fisher, one of the most respected economists in America, declared in October 1929, days before Black Tuesday, that stocks had reached a permanently high plateau. He was wrong, but the reason he was wrong isn't that he was stupid, it's that he had spent so long inside the logic of the expansion that he could no longer see it from the outside. You're not Irving Fisher. You're not a central banker with a political need to project stability. You're someone sitting outside the institution, and that is an advantage you should not waste. The people who preserved wealth, and in some cases built it, during 1929, during 2008, during every major contraction in between, weren't necessarily the ones who predicted the exact timing. Timing markets is mostly luck. What they did was something more basic. They looked at the structure of things as they actually were, not as they were being described. They asked what things were actually worth. They held liquidity when everyone around them was leveraging up. They didn't panic, but they also didn't pretend. This isn't a video telling you the world is ending. It isn't a prediction with a date. What it is, what I hope it is a frame, a way of reading what's happening around you that goes beyond headlines and quarterly reports and reassurances from people with something to lose by telling you the truth. History doesn't repeat, but it does rhyme with an almost unsettling consistency. The tulip traders of 1637 and the mortgage-backed security traders of 2006 were separated by nearly 4 centuries, different continents, completely different technologies and instruments, and they made almost identical psychological errors. Not because people are stupid, because the pressure to participate, to not miss out, to trust that the people in charge understand what they're doing. That pressure is constant across every era. The question history keeps asking isn't whether a collapse is coming. They always come. The question is whether you're the person who looked clearly at the structure of things and made decisions accordingly, or the person who decided the music was still playing and stayed on the dance floor one song too long. I want to hear from you. Drop a comment below. Do you think we're closer to a correction than the mainstream is admitting, or do you think the warning signs are overstated? There's no single right answer here, and I genuinely want to know what you're seeing from where you sit. If this gave you a different lens on what's happening economically right now, share it with someone who needs to hear it. Not because it's alarming, but because clear thinking is rare, and the people in your life who care about their financial future deserve access to it too. History gave us the warning. The only question is whether you're listening.